Imagine owning one of the most dominant names in digital payments. PayPal was everywhere. Millions of consumers trusted the button. Merchants wanted access to its users. And Venmo was becoming part of everyday life. During the pandemic, that story became even more powerful. PayPal's stock climbed above $300 in 2021, and the company was valued at roughly $360 billion. Wall Street was not simply pricing PayPal as a successful payments company, it was pricing it as a long-term fintech growth machine. Then the story reversed. By 2026, the stock had fallen to a 52-week low, around $38, roughly 87% below its 2021 closing high. That was not PayPal's literal all-time low. The shares traded lower shortly after the 2015 spinoff, but for long-term shareholders, it felt like a complete collapse. And here is the important part. PayPal did not disappear. It still processes enormous payment volume, still has hundreds of millions of active accounts, and still generates billions of dollars in cash. So what went wrong? Reason number one, the pandemic created growth that could not last. In 2020 and 2021, consumers suddenly shifted toward online shopping, digital wallets, and contactless payments. PayPal benefited from almost every part of that change. Investors began assuming those growth rates would continue for years. But when stores reopened and consumer behavior normalized, e-commerce growth slowed, and PayPal's growth rate came down with it. At the same time, the old eBay relationship was winding down, removing another source of payment volume. The problem was not that PayPal stopped growing overnight. The problem was that Wall Street had valued the company as if extraordinary growth was normal. Once growth normalized, the valuation collapsed with it. A stock priced for perfection does not need a broken business to fall. It only needs a business that becomes less perfect. Reason number two, PayPal's most valuable product, branded checkout, started losing momentum. Branded checkout is the PayPal button you see when buying something online. This is important because it is generally more economically attractive than simply processing payments in the background. But the checkout world changed. Apple Pay became deeply integrated into the iPhone. Google expanded its wallet. Shopify pushed Shop Pay. Stripe became a major merchant platform. Consumers increasingly expected one-tap checkout, built directly into the device or website. PayPal was no longer the obvious digital wallet choice. By the fourth quarter of 2025, PayPal's branded checkout payment volume was growing only about 1%. In the first and second quarters of 2026, it improved to around 2%. But Wall Street still wants much stronger evidence that PayPal can protect and regain relevance in its core franchise. Reason number three, payment volume kept growing, but the quality of that growth became a problem. This is one of the most important ideas for beginners. PayPal can process more dollars and still disappoint investors if those dollars generate less profit. Braintree, PayPal's unbranded payment processing business, helped the company win huge merchants and grow total payment volume. But large merchants negotiate aggressively. Processing margins are thinner, and PayPal historically prioritized volume and market share. Analysts have criticized the company for pricing too aggressively and not earning attractive enough returns. This meant that headline payment volume could look healthy, while transaction margin growth remained much weaker. In the second quarter of 2026, total payment volume grew 9% on a currency-neutral basis, yet transaction margin dollars increased only 1%, or 3%, excluding interest on customer balances. That gap explains why Wall Street no longer celebrates volume alone. Reason number four, the user growth story stalled, and PayPal struggled to turn its huge ecosystem into faster growth. PayPal had about 426 million active accounts at the end of 2021. It reached 435 million in 2022, then fell back to 426 million in 2023 before recovering later. That told investors The company could no longer rely on simply adding tens of millions of new accounts. Venmo was enormously popular, but popularity does not automatically equal profit. PayPal needed to monetize Venmo, debit cards, pay with Venmo, buy, now pay later, merchant offers, advertising, and other services without damaging the user experience. Some of those businesses are now showing better growth, but for years, investors saw a giant network without enough evidence that each user was becoming meaningfully more valuable. Reason number 5. Execution problems destroyed Wall Street's confidence. PayPal moved from one turnaround story to another, changed priorities, cut costs, launched new products, and went through repeated leadership changes. In February 2026, the board replaced CEO Alex Chriss and openly said the pace of change and execution had not met expectations. Then PayPal delivered a weak 2026 profit outlook, while branded checkout growth had slowed sharply. The stock fell about 20% in a single day. Enrique Lores became CEO in March, making him the company's third CEO in 4 years. For investors, this created a simple question. If PayPal's assets are so valuable, why has management struggled for so long to turn those assets into durable growth? So is PayPal actually broken? Not necessarily. The company ended 2025 with roughly 439 million active accounts and $1.79 trillion in annual payment volume. In the second quarter of 2026, revenue reached about $8.7 billion. Adjusted earnings beat expectations. Payment volume grew 9% currency neutral, and management raised its full-year profit forecast. But operating margin also declined, and branded checkout remained at only about 2% growth. That is why the stock can look cheap and still remain controversial. Investors are not asking whether PayPal will survive. They are asking whether it can become a growth company again. For Wall Street to become meaningfully bullish, watch 5 things. First, branded checkout needs to re-accelerate, not just stabilize at 2%, but show sustained improvement and evidence that PayPal is holding or gaining share. Second, transaction margin dollars need to grow faster, proving that higher payment volume is translating into real economics. Third, Braintree must become more profitable instead of winning business mainly through aggressive pricing. Fourth, Venmo and PayPal's newer products need to become material profit engines, not just interesting growth stories. And fifth, Enrique Lores has to restore execution credibility by meeting guidance, simplifying the company, delivering promised cost savings, and showing that reinvestment produces measurable returns. PayPal is targeting hundreds of millions of dollars of near-term savings as part of a broader transformation, but Wall Street will want to see those savings translate into better growth and profitability, not simply lower expenses. For a retail investor, I would focus less on the daily stock price and more on a small dashboard every quarter: branded checkout growth, transaction margin dollar growth, operating margin, Venmo monetization, free cash flow, and management guidance. Also separate the operating story from takeover speculation. PayPal's shares rebounded sharply in 2026 after reports of a $60.50 per share offer from Stripe and Advent International. But a potential deal should be treated as optionality, not the foundation of the investment thesis. The real bull case is much simpler. PayPal proves its checkout business can grow again, converts more of its enormous payment volume into profit, and gives Wall Street confidence that the turnaround is finally real. If those numbers improve together for several quarters, the market may stop viewing PayPal as a fading payments giant and start viewing it as a durable fintech platform trading at a reset valuation. Until then, cheap does not automatically mean undervalued. The numbers have to prove the story.